Welcome back to this course. Today, we'll be discussing Module 7, which is International Financial Markets and Investment. By way of module objectives, by the end of this module, students should be able to understand the structure and functioning of global capital markets, including the role they play in facilitating international investments and capital flow. Students should also be able to identify different investment strategies that are applicable in international markets with a focus on opportunity and risk. Students should also be able to analyze currency risk management techniques, including hedging methods and the impact of exchange rate fluctuations on international investments. Students should also be able to explore global portfolio management and how to optimize risk and returns in a portfolio that includes assets from different countries. Students should also be able to evaluate the role of global capital markets in enhancing portfolio diversification and managing financial risk across international markets. By way of introduction, in today's interconnected global economy, financial markets play a critical role in facilitating the flow of capital across borders, enabling countries, corporations, and investors to access the necessary funding and investment opportunities. International financial markets are not only a key source of capital, but also a platform for diversifying investment and managing risk. Understanding the mechanisms and strategies of these markets is essential for making informed decisions in international investment and capital allocation. This module delves into the functioning of global capital markets, explores investment strategies tailored for international markets, discusses methods for managing currency risk, and introduces global portfolio management techniques. The goal is to provide comprehensive understanding of how to navigate the complexities of international financial markets while managing the risks associated with cross-border investments. Let's look at some of the key features of the global capital markets. We have equity markets, we have the debt markets, we have the forex markets, then we have the commodity markets. The equity markets, this is where stocks, these are stock exchange like New York Stock Exchange, Lagos Stock Exchange, allows companies to, the Lagos Stock Exchange is now called NGS, Nigeria's exchange group. It allows companies to raise capital and provide investment with ownership stakes. This is the primary role of this market. The debt market involves the issuance of bonds, helping governments and corporations raise funds at lower risk compared to equity markets. The forex market facilitates the exchange of currencies, playing a pivotal role in global trade, investment, and currency risk management. What about the commodity market? This is where trades in raw materials like oil, metals, and agricultural products, vital for pricing and stability. Now, this is the diagrammatic representation of global capital markets. Now, let's look at some of the risks involved in global capital markets. There are about 4 risks involved. The first risk is the liquidity risk. Secondly, you have geopolitical risk. Thirdly, you have regulatory risk. Then you have market volatility. The liquidity risk, this risk that assets cannot be, this is a risk that assets cannot be sold quickly enough to prevent a loss, especially in illiquid markets. Then you have geopolitical risk. Political instability or change policy that affects capital flows and market sentiment is known as geopolitical risk. Regulatory risk, these are risks involved in changes in laws or regulations, impacting financial markets, affecting the operations and profitability of these markets. Then we have market volatility risk. Market volatility risk involves economic turnedowns, interest rate changes, and global events like financial crisis that can cause sharp fluctuations in asset values. Now let's look at investment strategies in international markets. Now let's look at the global asset allocation. This is diversifying investments across multiple asset classes, such as stocks, bonds, commodities, and the others, and regions to reduce your portfolio risk. Because if you invest in a particular thing too much, there is a risk there. Then we have emerging markets investments. This is targeting economies with rapid growth potential despite higher risk levels. Then we have global equity investments. This is investing in the stocks of multinational companies or global equity indices. Then we have global fixed income investments. These are bonds. These are bonds issued by foreign governments or corporations that provide a steady income stream. Let's look at currency risk in international investments. We have currency fluctuations. This is changes in exchange rates affecting profitability of international investments. This is known as currency fluctuation. Changes in exchange rates affect profitability of international investments. Then we have hedging strategies. The use of forward contracts and swap to mitigate currency risk. An example is a US company importing goods from the Eurozone is exposed to currency risk if the dollar weakens against the euro. Now let's properly look at the hedging techniques for currency risk. We have forward contracts, we have currency options, we have currency swaps, we have natural hedging. The forward contract, this lock-in exchange rate for future transaction. Then currency options provides the rights but not the obligation to sell or buy currency at a determined rate. I've talked about these hedging techniques before. I'm just going in depth. Currency swap, this is an exchange of cash flows in different countries over time to manage long-term foreign exchange risks. Then let's look at natural hedging. This is aligning revenues and expenses in the same currency to reduce exposure to exchange rate fluctuations. Now let's look at global portfolio management. Let's look at the first, diversification. This is spreading investments across different countries, sectors, and asset classes to reduce overall portfolio risk. Then we have the efficient frontier. This is identifying the optimal mix of assets that maximizes returns for a given level of risk. Then we have strategic versus tactical asset allocation. Strategic is long-term, while tactical adjusts to short-term market opportunities. Let's look at currency risk management in portfolios. This is mitigating currency risk with hedging or investing in currency hedge funds. And let's look at diversification in global portfolio management. We have geopolitical risk here. We have economic cycles. We also have currency risk. Geopolitical risk reduces reliance on a single market, protecting the portfolio from country-specific risk. We also have economic cycles. This is different markets moving in and out of sync, reducing overall risk by including diverse markets. Then we have currency risk. By holding assets in different currencies, investors can protect against adverse fluctuations. By way of conclusion, global portfolio management is an essential approach for investors and institutes looking to optimize their risk-return trade-off across international markets. By diversifying investments across various asset classes, regions, and currencies, investors can reduce their risk, capture growth opportunities, and protect themselves from market volatility. Effective portfolio management requires an understanding of global financial markets, the strategic allocation of assets, and the use of currency risk management techniques. With the right strategies, investors can successfully navigate the complexities of global markets, achieve their financial goals, enhance portfolio management over the long term. By balancing developed and emerging market assets, applying sound risk management strategies, and utilizing advanced techniques such as the efficient frontier and asset allocation, global portfolio management helps investors to build resilient portfolios that are positioned for success in an interconnected global economy. At the end of this module, there's an assessment session where there's quiz of 15 and a report session. That'll be for module 7. I'll see you in module 8.